Welcome, everyone, to our November State of the Markets webinar. I'm Joe Zappia, Principal and Co-Chief Investment Officer at LVW Advisors. I'm joined today by my partner, Jonathan Thomas, and today we're going to talk a little bit about where markets stand. We're going to talk about what's on client minds. We'll hit on gold, bubble fears, all-time highs, inflation, the Fed, and we plan on sharing some insights that you just won't find in the headlines. So, Jonathan, welcome. Let's dig in and have fun.
All right, let's do it.
All right, so in a continuation from the webinar that I did last month, 2025 is turning out to be the everything rally year. You can see gold leads through October up 52%, which is pretty stunning. And then emerging market stocks up over 33, international stocks, Bitcoin, all up significantly. I think the most interesting thing about this slide is that U.S. large cap stocks, with all of the talk, and we'll hit on this later, but with all the talk of a bubble and concerns about prices in the U.S. stock market, it's not the U.S. stock market this year that's leading, not even close. We'll dig into that a little bit more later. So let's just take a look at the major asset classes in the United States year to date. Again, this is through the end of October. The S&P 500 is up 16.3%. The Dow Jones Industrial Average, which tends to be a little more cyclical, a little more of the belly of the economy, is only up 11.8, and the tech-heavy NASDAQ is once again significantly outperforming the other indices. It was up just under 23% year to date.
This slide tells a pretty powerful story. Investors who held through April's market panic have been rewarded once again. Across developed and emerging markets, US large, mid, small caps, the returns for those who stayed invested far outpace those who sold at the lows. So it's a classic lesson. Timing the market is really tough. Discipline seems to always pay off, right? If you felt the urge to sell during the downturn, you're certainly not alone, but history shows that patience is often the best strategy.
Yeah, it's pretty crazy.
Yeah. So this is good too. As of the end of October, October 31st, the S&P has spent 106 trading days in a row within 3% of its all-time high. So markets have been basically at all-time highs for 106 straight trading days. This kind of resilience, it's rare, but it's not unprecedented. Like we've had periods far higher in the late 90s in the tech bubble, et cetera. But still, it's been a long time trading at or near all-time highs. It's been a lot of skepticism among clients, assuming that this has to end at some point. But these charts always put things in a good perspective, right? Like this has happened before, it'll happen again. It's been much more crazy than this. It's not that unusual. And then many investors, they worry that buying at all-time highs, like I said, means that a correction is imminent, but really the data tells a different story. I know it's pretty similar whether you're investing at all-time highs or investing on all other days. The returns are pretty similar, but they're certainly not like way off, right? It's not like when you buy at all-time highs, all of a sudden your returns are far worse if you look out 1, 3, or 5 years. Again, I think it's just having a plan, sticking to your plan and staying the course when things get a little choppy.
Yeah, and one thing I would just add here quick is this is 75 years worth of data in that chart. So this isn't just recently. So 75 years of data shows that whether you buy at all-time highs or any time, you typically are going to end up with the same return.
Yeah. Human nature too. Like every single time I talk with clients about maybe investing like a rollover, putting money in the market, it's always, well, is now really a good time? And really, like when markets are at all-time highs, you should argue that it is probably a better time than any time. But human psychology and the way we're kind of meant to think, it just, for some reason, we're more fearful when things are at all-time highs.
No question.
So, I mean, so obviously markets are at all-time highs and there's fear there, but are we in a bubble? I mean, that's everywhere you look. I don't watch the news religiously, that's for sure. I really try to avoid it. I try to get clients not to focus so much on it. But that just seems to be everywhere. So let's address the bubble question. So this looks at some of the 4 largest blue chip stocks during the dot-com bubble. both back during the dot-com bubble and then today. So for the big tech leaders, Google, Nvidia, Apple, Microsoft. The companies in March of 2000, those tech giants, they were trading at extreme multiples, like extreme, 120, 130 times earnings. Today's great companies are trading much smaller PE ratios, 25, 30, 32, 33 times earnings, much more reasonably valued. And I mean, obviously what that says to me is that these companies actually have earnings
Yeah,
where,
yeah, I agree. I also think it says like, look, they're not cheap by any means, but these companies are nowhere near the crazy valuations that we saw in the 90s.
yeah, 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 where there was no way that they could have exceeded those high expectations.
Right.
Hmm.
Fundamentals matter, and markets look a lot different
Yeah,
today than they did in the late 90s and early 2000s. Even though the market's gone up as much as it has, the earnings have really um, been driving that. Earnings have actually grown faster than PE ratios over the last year, which means the market's technically not getting more expensive.
yeah, yep.
So another area we want to hit on is gold. Lots of clients are calling. It's interesting, an asset goes up a lot, it gets in the news, it's in headlines. And then there's always a narrative behind it. Is gold going up because of a dollar debasement? Is gold going up because central banks don't want to own our bonds anymore? Who knows what it is. It might be a little bit of each. But I think that what this chart shows is that over the past 3 years, gold has outperformed the S&P 500 by 50, almost 55%. And what's amazing about this is the 3-year return for the S&P 500 is almost double the 100-year average. So that's how much more gold has gone up than the market. And you can see it does go through long cycles. I think that what we would say here is that, diversification does help you weather cycles, but adding gold after this level of outperformance today um, might not be the best thing. So now we're going to talk a little bit about things that wouldn't be so obvious to most of the people watching this. And this is what I call an insight slide. So what this chart's showing you is the number of stocks in the S&P 500, the mid cap index and the small cap index that are currently trading above their 200-day moving averages. And for professional investors, the 200-day moving average is basically suggesting that a stock is in an uptrend, that in general the stock is performing better than um, it's performing better than it has over, let's say, most of the last trading year. And the reason we pay attention to this is because you can get indications for if the market is broadening out. In other words, more stocks are going up, or narrowing, where fewer stocks are going up and more stocks are going down. And right now, what we're seeing is we are seeing some divergence in the 200-day moving average. So what it means is that both all three small, mid, and large cap stocks, there are fewer stocks trading above their 200-day moving average than the 20-year average. And this is a chart we monitor on a weekly basis. So there's fewer stocks in an uptrend today than is typical for the market. And if we zoom in a little bit more and look at the next slide, the gold asterisk is the 20-year average. So on a 50-day basis, which is a shorter term look, between 34 and 40% of the stocks that trade are above their 50-day moving average. That's weaker than the long-term trend of the 200-day. And it does suggest that there's fewer and fewer stocks that are performing well on a short-term basis. And it just sort of reinforces that momentum is cooling across the market. So as we're looking at markets making all-time highs, as Jonathan talked about, we're also underneath the surface seeing fewer and fewer companies making those new all-time highs along with it. And that suggests a narrowing market, as I talked about last month.
Yeah, so let us spend a moment on inflation and the Fed and interest rates, another hot topic. So the 5-year break-even inflation rate stands at 2.4% today, and the 10-year is at 2.3. So these rates, they reflect market expectations for average annual inflation, and obviously very closely watched by policymakers and the Fed and investors. Rising short-term expectations can signal concerns about inflationary pressures, while long-term rates offer a window into future trends. And I think everybody in April when the market sold off 11% in 2 days, what was it, right?
Yeah.
Was worried about a spike, a big spike in inflation because of tariffs and the impact and the unknown. And I don't even see a blimp here of what happened 6 months ago, um, both in terms of inflation expectations and the actual data that we're seeing. So I think that's a big part of the reason why we're at all-time highs was because somehow we were able to avoid that dreaded inflation spike that everyone feared in April.
Yeah, totally agree. The market doesn't lie.
Right. So we know the Fed's cut rates a couple of times this year already. Expectations are that they're going to come down. The effective federal funds rate is currently at 3.87. You see it's come down since about 5% just a few years ago. We're expecting that to decline down to like 3.1 by the end of 2028, give or take. A lot of people pay attention to this because of the money market fund yields, right? So 2020, 2021, we know we were getting like no interest on our money market funds and it spiked right up to about 5%. It's been coming down a little bit. So still more than inflation. So cash is still a pretty good investment, but you see that the trend is certainly going down because inflation is also coming down. So this kind of looks at treasury yields, both the 10-year treasury and the 2-year treasury. The 10 year is currently at 4.09%, 2 years at 3.6. So higher yields, they often signal confidence in the economy, and lower yields can indicate caution. Rates have kind of come down a little bit, but I think that that's just more of a function of inflation being flat to actually dropping. So
Yeah, I just add something here quick too. Two things. Number one, I see on the chart that we have seen a little bit of an uptick in yields here over the past few weeks. I don't really think it means much yet, but we have seen yields tick up a little bit. And the other point I would make is that I'm a big believer that the 2-year Treasury yield really does dictate what the Federal Reserve does. The 2 year has done a really good job forecasting where the Fed should be. So on the previous slide, Jonathan showed that the Fed funds rate is now like at 387. The 2-year yield is telling us that there's probably about one more cut that needs to come, and the Fed will be at about the 2-year Treasury yield, which I think is what the market is saying is about the appropriate neutral rate given the economic growth in the economy, some of the remaining uncertainty about tariffs, um, and where we are with inflation.
yeah,
Pretty
okay.
benign, though. Pretty benign. And the last topic we want to hit on this month is the government shutdown. I forget which day we're in now, but we're over 30 days. A lot of people thought it would be done by November 1. Many people thought it would be done by today, which happens to be election day. It's still not over. And who knows how long it'll go. But aside from, some of the awful ramifications of the government being shut down, our job is to think about what it means for markets. So there's been a lot of shutdowns. This is not unprecedented, and you can see that the returns have sort of been all over the map during government shutdowns. But in general, the market has generally gone higher, and I think that the big takeaway here, probably more than anything, is government shutdowns don't necessarily mean that the market has to have a massive correction or crash or do anything terrible simply because the government shut down. So that's the big takeaway here.
Yep.
All right, well, that's our summary for this month. The next couple pages are disclaimers, disclosures, and just remember that what we talk about on these webinars really shouldn't be used as investment advice. And we welcome your feedback, we welcome your comments, and we'll see you again next month.
Awesome. Thanks, Joe.